in terms of like getting the budget documents, they handed them out on USB keys this year, and as I was listening, in the room, like we were sitting about two-thirds into the room. The people in the front of the room were getting their USB keys first, and you could just hear rumblings and rumblings and rumblings, and it was just you hear somebody in the distance say capital gains, capital gains, and you start hearing the capital gains thrown around a few different. So then, yeah, first thing I'm just like, okay, something big is in here, right? And you put the USB key into into the computer, and then the first thing you see is like capital gains inclusion rate increase, and I'm like, wow, they finally did it right after years of speculating.
That's the voice of Hemal Balsara, head of tax, retirement, and estate planning, individual insurance with Manulife, talking about the live reaction of the closed chamber meeting when the budget proposal was first introduced. You can hear him talk about how that wave of capital gains chatter moved through the room, and certainly we've heard a lot about it since then. So I'm sitting down with Hemal today to talk about how is this budget impacting individuals, people with corporations, and what you can do about it. As always, before you make any changes to your personal situation, please consult someone who understands your unique situation from a tax perspective and a financial planning standpoint. All right, now enjoy the show.
Yeah, it's a pleasure being here, Galen. It's one of those things where this budget change and the capital gains inclusion rate change specifically has been a subject matter area that I've been talking about since the budget date. And it's already been, a month and a half. And the reality is there's a lot of speculation, but there's not any draft legislation. So this is the hard part is we're kind of speculating where the ball is going, but we know for sure, based on all of the commentary that we're seeing, both at the KLU conference, representatives from finance and CRA were there. Representatives from the Liberal Party were there. It just looks like this is going to be going through. It just doesn't have any draft legislation tied to it at this point.
Yeah, that's very good to point out because I mean, certainly when I'm talking to people, I'm encouraging them not to do anything yet, just because as of the recording of this podcast, nothing has been changed yet, but the proposals are there. So and that's one of the things I want to talk about is like, is there anything people should be doing to prepare themselves for the potential changes? If the changes go through, what should people be doing? Like, where are you at with that sort of like advice lever?
Yeah, that's a wonderful question. And the way I look at this is if we take a step backwards, really what was proposed was a two-thirds capital gains inclusion rate. And it's effectively going to be applicable from dollar one for both corporations and trusts. So basically, when I say dollar one of capital gains, we're going up from a 50% tax rate in a trust or a corporation to a two-thirds inclusion rate. So effectively, what's going to end up happening with that is from dollar one in these entities, we're going to be subject to a higher rate of tax. On the flip side, with individuals, one of the things that they did was they provided some relief. So the first $250,000 of capital gains is only going to be taxed at 50% inclusion rates for the individual. And then after that, each incremental dollar above and beyond $250,000 is going to be taxable at the two-thirds inclusion rate. So for an individual, what that means is if you've got more than $250,000 of capital gains in Ontario, we're looking at going up from 26.76% to about 35.69% approximately. So at the end of the day, the way I translate this is effectively for individuals, to the extent that you have capital gains more than $250,000 in your hands, effectively per $1 million of capital gains above and beyond $250,000, there's going to be $89,000 of extra taxes that would be owing as a result of that. So, kind of coming back, to your original question was really in terms of actually doing this and triggering gains. The way I look at it is it kind of comes back to the fundamental question, where are you going to sell the asset, right? Like
Mm-hmm.
anyway, sometimes there's like assets which are emotional in nature. So for example, we have a cottage, right? A family cottage, right? There's memories, there's all the good things, those great summer memories
Mm-hmm.
that many people have when they spend time in their cottages. The reality is selling your cottage before June 25th it's going to be A, hard, right?
Mm-hmm.
Like, B, you know, my understanding, I don't own a cottage, but like, my understanding of the way the cottage market works is you put a cottage on the market, it can take several months for it to ultimately sell. So the reality is, if you're trying, unless you're going to put yourself in a distressed fire sale situation,
Mm-hmm.
which you're not going to optimize asset value, it doesn't necessarily make sense for those emotional assets to necessarily do something. If, however, we're in a situation where, there's big capital gains that are anticipated, or there's big capital gains that they're already like, we have pregnant capital gains. The issue that we really have here is effectively one where does it make sense to trigger them? And my answer to that question is a little bit different for individuals and trusts,
Mm-hmm.
because in 2023 they introduced or proposed changes to the alternative minimum tax rules. And in the 2024 budget, they've actually decided to proceed with those changes effective January 1st, 2024. So the issue that you have, especially as an individual or a trust, triggering large amounts of capital gains where you have little or no other income, all of a sudden, even though your income tax bill can be lower and you can benefit from that 50% capital gains inclusion
Mm-hmm.
rate, the issue that you run into is now AMT can be the surprise when you file your 2024 tax return,
Mm-hmm.
because because right now, based on the way the numbers work out, capital gains effectively now become, under the new rules, become 100% income inclusion for alternative minimum tax purposes. And what happens is now, with alternative minimum tax, that can actually add a cash cost to doing this. So for individuals, you end up, getting $173,000 deduction. For trusts, basically you're subject to AMT from dollar one.
Mm-hmm.
So the issue that you run into, and I'll maybe, for the benefit of everybody who's listening, alternative minimum tax is a nasty tax, and it's basically, you calculate your taxes the regular way, and then you have the alternative minimum tax way.
Mm-hmm.
And the issue with the alternative minimum tax way is it takes away favorable tax attributes, right? So instead of getting 50% inclusion rate for capital gains for regular tax purposes up until June, 20 June 24th, effectively we're now in a situation where that capital gain for AMT purposes is 100%. So now all of a sudden there can be actual cash taxes that are owing as a result of this. So the higher your capital gains income relative to the other sources of income that you have, you're now in a situation where you could potentially face AMT, go forward on that. So that's the first piece of the puzzle, I'd say,
Mm-hmm.
is work with your tax professionals to figure out whether AMT is going to be a problem or not, right? Because
Mm-hmm.
otherwise, cash taxes owing, it kind of defeats the purpose of doing this exercise. On the corporate side, this is where the conversation gets juicy, right? Because now what's happening is effectively the corporations don't get that $250,000 being taxed at 50%.
Mm-hmm.
So now all of a sudden, if we've got pregnant gains in our corporation, this is where it can make sense to liquidate liquid investments, not investments that could take a long time to
Mm-hmm.
potentially sell in the marketplace, but just more like your stock portfolio, things like that, where you might want to crystallize, that capital gain, because effectively in the corporate environment, we're going from a situation where we get a 50% inclusion rate to now being, two-thirds right from dollar one in terms of capital gains. And the other thing that I also wanted to add as well is, as part of this, one of the things that happens from a tax lens is capital gains create CDA,
Mm-hmm.
right? So the non-taxable portion of capital gains gets added to our CDA, or added as credit to our CDA. So the issue that we face here is our non-taxable portion in a 50% tax or 50% inclusion rate is effectively half of the gain is non-taxable. So therefore you get half credited to your CDA.
Mm-hmm.
In this new environment, at a two-thirds inclusion rate, you only get one-third credited to your CDA. So that means there's less benefit, in terms of creating CDA as well. So I bring that up more from the lens of like, if we look at the integrated tax cost of actually paying out, that, basically incurring that capital gain and paying out that dividend, all of a sudden that goes up tremendously,
Mm.
in the new environment. And this is where I'd say, especially for liquid investments, you know, it might be worth crystallizing gains, today. But again, talk to your financial advisor. Make sure that it makes sense. I don't want to create like like distressed markets, like trying to
Yeah,
crystallize
yeah.
gains, right? Too. So you got to do it the smart way. But generally speaking, this is one of those things where it may be worth considering,
Hmm.
right? Is that so?
Hmm.
Yeah.
Yeah.
So a few
Yes, I mean, you
pieces there.
covered, yeah, definitely a lot of pieces. So, I mean, you covered a lot of ground there around individual versus corporate, and then the type of asset that makes sense to consider selling. Like you said, like on the individual side, cottage in the family for a really long time, you don't necessarily want to try to sell it super quickly and, just to help with this issue. Whereas on the corporate side, especially with an asset that, is a stock portfolio, for example, that, probably doesn't have a lot of emotional attachment and that can be sold quickly, in a matter of days instead of months, as opposed to a cottage. So one quick thing I wanted to bring up, around the difference between personal and corporate is on the personal side. My sense is that, it's very rare that a person during their life would intentionally trigger the sale of a portfolio that would trigger a capital gain that would use up all of that room and then end up in the new bracket, because it would be like it wouldn't make sense for someone to sell that much all at once. So so with the individual, it's assets like, um, secondary residences would be a big one that would fall under this new rule, right? And then what about when it comes to estate planning? Like, is that the point at which people, like if someone has a really big portfolio that's grown over the years and then as part of their estate, would that be affected by this new rule if it were a large enough capital gain?
Oh, absolutely, absolutely. I mean, the reality is, to your point, in the budget document itself, it said it impacted 0.0013% of the people.
Mm-hmm.
So on the record, that's what it says. Talking to people out on the street, over the last month and a half, it seems like there's far more people that may be impacted, especially to your point, in terms of like a windfall year. And what I mean by a windfall year, let's just say, for example, you got into Tesla really early as a stock, and
Mm-hmm.
then all of a sudden you decide to sell it, huge capital gains there, or Apple early, like, or any one of these
Mm-hmm.
companies that grew from being a small number to a really, really big number. Additionally, to your point, a big driver of this is basically real estate that doesn't qualify for the principal residence exemption,
Mm-hmm.
right? So, yeah, as you can appreciate, that the principal residence exemption allows us to shelter capital gains relating to the sale of a
Mm-hmm.
principal residence, which is a home that we ordinarily inhabit. But the reality is sometimes people can have two principal residences like that, the regular home and the cottage. And when you sell, you have the option of designating
Mm-hmm.
one or the other as your principal residence. And at the end of the day, you kind of want to optimize in a way that, the largest capital gain is the one you end up sheltering. But,
Mm-hmm.
you know, anyways, to your point, yes, selling a property, either like a rental property or that second home, which doesn't qualify for that principal residence, is going to create a windfall, especially in today's environment,
Yeah.
especially where you had mature real estate. Like all across the country, we've seen real estate values skyrocket over the
Mm-hmm.
last, several years. And if you bought 20 years ago, you're probably making out really, really well in terms of
Mm-hmm.
that profitability. So it's going to result in extra cash taxes and less coming, into your own personal genes as a result of that.
Yeah.
And then you've highlighted another area, which is really, the terminal return, right?
Mm-hmm.
So when one passes away, they have a deemed disposition of all of their assets at fair market value. So what ends up happening is, to the extent that, we've got, assets that have appreciated in value, now all of a sudden we're going to actually have cash taxes owing when we pass away. The only exception is if we leave the assets to a surviving spouse or a
Mm-hmm.
spousal trust, right? So that way we could defer the tax until the second death of the two spouses. But at the end of the day, really, the issue is one where we can ultimately have a higher terminal tax bill. And I think the reality is even at KLU, there was a representative from the Parliamentary Budget Office, and he ended up just um, talking about the impact of this capital gains and how it would increase revenue. There was another representative, from the Liberal Party who cracked a joke saying like, this is good for the insurance industry because now, we've
Mm-hmm.
got extra terminal taxes to help fund. And the reality is this is one of the things I've been talking to many of my insurance advisors about is this one stings for everybody. And to the extent that you know the financial advisors have been working with their clients to fund terminal tax obligations. Now all of a sudden that terminal tax bill, especially if you've insured for only the amount of the terminal tax, now all of a sudden, in Ontario it's going up by 8.9%. So like,
Mm-hmm.
so kind of coming back to those numbers I said, a very simple, you know rough like rule of thumb, like 89 grand per million, right? Like on personal capital gains, right? So all of a sudden, somebody with you know a tax exposure of or capital gain of $10 million now has $890,000
Mm-hmm.
extra of terminal taxes as a result of this rate increase. So it's definitely going to sting across the board.
Yeah.
But at the same point in time, this is, this is one of those things where, the government's been spending a lot of money, and the reality is too, smart, clients who worked with smart tax practitioners were doing, things to help strip out money from their corporation at capital gains rates rather than dividend rates.
Yep.
So taking advantage of those favorable rates. So now all of a sudden, with with a combination of the rate increase going through, and then also some of the new rules around the general anti-avoidance rule, it's really going to, crack down
Mm-hmm.
on surplus stripping
Mm-hmm.
transactions, for example.
Oh
So
yeah.
yeah.
No, that's a good point too of like the things that people have been doing traditionally to maximize their corporation may not be there to anymore. And I think so. You mentioned a little bit about so I mean, what I wanted to touch on is we talked about the personal side a bit versus corporation, about estate planning side of things. Now, when it comes to incorporated professionals, like I work with physicians. This podcast is for physicians. Almost every physician I meet, at least if they're even a couple years into practice, they've got a corporation. If they're saving for retirement, they're saving a chunk of money in their corporation. Sometimes it's the largest place where they're saving money in the sense that maybe they've used up TFSAs, maybe they've used up RSPs. Now they're using the corporation to also save as a source of income in retirement. So what would you say around, is this impacting physicians potentially in more than other types of people who have corporations, and what are some of the things that they can start doing about it? You did mention already, to kind of work with someone to see if it makes sense to trigger gains before the deadline or after, but then beyond that, what are some of the other things they can be looking at?
Yeah, so I mean, first off, I want to say, to all the physicians on the line listening to this, thank you for your service. You play a critical role in our society, and thank you for everything that you do. And you guys, should be, I'm a big fan of what you do, and thank you for everything that you do. So, in terms of the physicians themselves, right, in particular professional corporations, if we break down the impact and what it's going to actually impact is really in a couple of places, right? So to the extent that we have, for a physician who has a professional corporation, to the extent that we have a physician with that professional corporation, um, the first thing is on an inter vivos basis, to the extent that we trigger gains in the corporate environment, we're going to see higher capital gains taxes on any realized gains go forward after, once we hit June 25th onwards. So that's really the first thing is if we're generating capital gains, the first thing that I would say is now this might require working with your financial advisor to first figure out where is the best place to have capital gains being generated.
Mm-hmm.
And the reality is if we look at it on an integrated basis, the first $250,000 being taxed at 50% in your individual hands actually creates, permanent tax savings of over 5% if you compare it to earning it through the corporation, right? So because
Mm,
integration and the way things work. So the first thing that I would say is look at maximizing your capital gains earning potential personally as opposed to through the corporation. So this would involve revisiting and rebalancing your portfolio so that the capital gains portion is in your hands personally so that you can soak up the 250K each year. And then earn the maybe the interest and some of the other the dividends portfolio type investments through the corporation rather than your hands individually. So this would involve kind of like a shift in thinking as it
mm-hmm,
relates to the overall portfolio. The second thing that I would say with this is in terms of doctors who were you know professional corporations are really being used for tax deferral, right?
mm-hmm,
So individuals get taxed 53.5% in their hands personally at the top marginal tax rate. Meanwhile, corporations on the first $500,000 gets taxed at 12.2%. So there's a 41.3% deferral opportunity on the
mm-hmm,
first $500,000. So you're basically maximizing cash in your ecosystem by deferring through the corporation. And the reality is if the from an income planning perspective during your retirement years, if the goal was to just strip down the assets from the corporation in the form of dividends, effectively what would happen in this situation is there's really no change to dividend rates at this point.
mm,
So effectively, for those of you who were looking at generating dividend income from your corporation in the form of eligible or non-eligible dividends, you're still going to be in the same boat, right? They haven't touched the tax rates for that. Where it is going to be interesting is I've heard of situations where accountants have been promoting ideas in the past of what we call surplus trips, right, or
mm-hmm,
or capital gains trips, where rather than pulling your money out at dividend rates, you're pulling your money out at capital gains rates. And so in Ontario, it works out to about 29% for a capital gains trip, pre all of these changes, versus 47% for a dividend, right? So
mm-hmm,
so there was actually some efficiency to doing that. The reality is those strip transactions were going to become problematic anyway under the new general anti-avoidance rule. So the reality is the days for those transactions were kind of numbered,
mm-hmm,
anyway, potentially, right? So again, talk to your tax practitioner if you really want to drill down on how this works and whether they think it works. But my understanding is the general anti-avoidance rule is going to be really highly problematic in the context of these transactions go forward. So anyways, if we look at this, where are we at, right? So, really what it's impacting is really two things. To the extent that we generate capital gains in the corporation on an inter vivos basis, but that could be managed somewhat, in terms of trying to earn that, capital gain in your hands personally. So this will require portfolio rebalancing. The
mm-hmm,
other place that it's going to impact is to the extent that you have that professional corporation and you own those professional corporation shares when you pass away. Effectively, there's going to be a higher capital gains exposure, right? So for every $1 million of value, we're going to get hit with $89,000 of extra tax, right? So, and some of that tax can be minimized if we do transactions that we call post-mortem planning. So we can
mm-hmm,
take advantage of what we call the 164(6) loss carryback, which requires winding up the corporation after we pass away within one taxation year to basically create a capital loss that can be carried back to the terminal return and basically put ourselves in a position where we only end up with like a single layer of tax. And when we have life insurance or CDA created as part of this transaction, effectively we can now actually end up with a much lower effective tax rate as a result of that. So one of the things that I could see happening, go forward is effectively, you know, to the extent that money's needed during one's lifetime,
mm-hmm,
yeah, make sure that there haven't really been any changes to the dividend rates, but it's really to the extent that we're not going to touch a bucket of money in that corporation. Now it could make sense to pursue, uh, you know, a strategy like, corporate owned life insurance, because effectively we can use those deferred tax dollars to fund that life insurance policy, and then we get CDA creation on the tail end. So effectively, we're turning taxable dollars into tax-free capital dividends. The only catch is the insured has to pass away. So you
Right.
can't have it all, right? So
Right. Yeah, no, that's a good point because I mean, I know there's certain things that, we've certainly looked at over the years that have I mean, so one of the things that we've looked at is a lot of times when we run those numbers of saving money in a corporation versus a tax-free savings account versus an RSP, like there's plenty of people that have chimed in on that, and a lot of what we were working under is it seems like deferred capital gains was like the winner inside of corporations for the most part. And now obviously this is, I mean, one part of it was, people needed to seek out ways to achieve deferred capital gains and not capital gains that were continuing to be triggered. So there are things like individual pension plan, things that we hadn't really looked at that closely in the past. We'd looked at them, compared them, looked at the pros and the cons and the trade-offs and all that, but those are the types of things that we're revisiting now just to say, okay, we made some decisions based on old rules around different strategies. Now we're going to revisit them based on potential change just to see, make sure that our the things that we're thinking about, it isn't just based on like old biases, but actually new numbers.
yeah, and I mean, I definitely think, revisiting the IPP strategy could make sense, especially if somebody hasn't maximized their RSP contribution room. I would say, like, take advantage of the tax deferral through the corporation, and obviously look into the IPP idea, right? See how the
Mm-hmm.
numbers play out for you, because, like, the reality is if you haven't been making your RSP contributions over the years, the reality is there could be some potential big savings associated with that, right?
Mm-hmm.
In terms of getting tax deferred growth. The only thing is with IPP income, when it does come out, it's going to come out as ordinary income, similar to an
Exactly.
RSP, right?
Yep.
So you don't get any favorable attributes associated with that.
But we have mentioned life insurance a few times, and as you may well know, like life insurance is a bit of a polarizing topic. Now, one of the things, is that life insurance has a unique characteristic when it comes to all these changes, in the sense that, it doesn't get wrapped up in these same legislative changes, right?
Absolutely. And I mean that's I kind of almost look at it as a lighthouse, in a storm with the stormy weather, in the sense that, you know, the, the reality is life insurance has a lot of tax efficiencies associated with it. You effectively, you can overfund it, right?
Hmm.
And effectively you get tax deferred growth in that policy. When the insured passes away, that death benefit gets received tax free by the beneficiary. And where that beneficiary is the corporation that owns that policy, effectively we get a CDA credit for the death benefit minus the adjusted cost basis of that life insurance policy. So effectively, let's just say, for example, we had $1 million death benefit and a $50,000 ACB on that life insurance policy. The corporation's getting $1 million of cash and a $950,000 CDA credit. And now
Hmm.
$950,000 can be paid out tax-free to the estate without any further tax implications, and the remaining $50,000 would come out as a taxable dividend. So my point with this is one where that becomes such a powerful mechanism, especially as tax rates are changing, tax rates are increasing, tax laws are getting tighter around more aggressive strategies. This is one of those things where, just a good, clean corporate owned life insurance policy could make a lot of sense. And, the other thing too is that tax deferred growth nature of this. I've met so many doctors over the years who've made the smart financial decision of engaging and having a what we call in the Manulife world a corporate insured retirement program, but really
Hmm.
it's effectively an overfunded life insurance policy that gets tax deferred growth that's leveraged at some point in time during the retirement years to create retirement income, for oneself, right? So the reality is there's a lot of good things that can still be done in terms of planning, and in particular with life insurance planning. A question that the audience might have is do I think there's going to be changes? And the reality is I think the changes for life insurance already happened, right? So there was what we call so what happens is when you overfund the life insurance policy, effectively there's like this imaginary line in terms of the amount of money that you could pump in, and it's called effectively called the MTAR room, the maximum tax actuarial reserve room. But basically, it's basically if you're below this line, this imaginary line, you're a life insurance policy. If you're above the line, you're now like any other financial instrument that you're subject to investment income growth and all of that good stuff. So, anyways, my point with this is that's the beauty of life insurance is because we're below the line. So you can't put in oodles and oodles of dollars
Mm-hmm.
into this. Like there's only you have to qualify and go through the process and everything like that. But my point with this is one where that tax deferred growth in that cash value can now provide another asset for any doctor and pretty much anybody with a corporation, or even you could do this personally as
Yep.
well. And then that could ultimately be, that asset can then be collateralized in the future to provide an income stream to the professional who has that policy. So,
Mm-hmm.
anyways, so kind of coming back to it, sorry, so I went down this exempt test, discussion. So, anyways, coming back to it, it was one where prior to 2017, there was a what we call the Generation Two iteration of the exempt test, and you'd be able to
Mm-hmm.
actually stuff a lot more money into policies, and the rules were a little bit more flexible. Now they've tightened those rules, so you can't actually overfund a policy as much as you used to over the duration of the policy. I think you could effectively what happens now is you could get a little bit more money in the early years than you could previously could, but then after that, effectively those numbers are lower. So my point with this is one where insurance has been impacted in a few different ways, and it was actually it impacted before all of these other changes have come
Mm-hmm.
through. So we're so anyways, long story short, because of those changes that happened previously, I think it's one where the future is really, really bright for existing life insurance now going
Mm-hmm.
forward.
Yeah, no, and I think it is. I mean, I think it's really good to point out the difference and the changes. I mean, I was still fairly new in the business when that change came through, but I remember we had tons of time to prepare for it.
Yeah,
Like it wasn't like this kind of a change that's been put through that's like pretty fast. Like we had at least I remember at least I was starting to get information about the changes a year before they were happening, and it was like, okay, what does life look like before and after? Does it make sense to take a policy before or after? Like, I mean, we had lots of time to talk to our clients about
absolutely.
the changes and how they're going to impact things, and then the other thing is, from what I've seen, I feel like life insurance companies have gotten more flexible in the way you can design it in the sense that, yes, obviously there's still the MTAR line, but I think the companies sort of address some of that inflexibility with just providing more options, I feel in general. So like, even though, yes, it made sense for people to take it out before the change, some people I found couldn't do it before the change. And I feel like some of them are even a better place than they were just because of the enhanced flexibility that we're finding available.
Absolutely,
Yeah.
absolutely. I agree with you. So, like, so I mean, and talking to a lot of professionals, it was funny. I was in the budget lockup. So that was actually one thing I didn't share with the group was in Ottawa. Um, they invite various tax practitioners out to review the budget documents before they're released to the public. So this year, they invited everybody in for 11 o'clock to read it, and they basically take everything. You take your cell phones, you turn them off. You take your Apple Watch, you turn it off. Like it's basically put in a special like special envelope that's taped up, and you don't get access to it. And one of the things that happened with this is you know, in terms of like getting the budget documents, they handed them out on USB keys this year.
Mm.
And as I was listening, in the room, like we were sitting about two-thirds into the room. The people in the front of the room were getting their USB keys first, and you could just hear rumblings and rumblings and rumblings. And it was just, you hear somebody in the distance say capital gains, capital gains. You start hearing the capital gains thrown around a few different. So then, yeah, first thing I'm just like, okay, something big is in here, right? And you put the
Yeah.
USB key into into the computer, and then the first thing you see is like capital gains inclusion rate increase, and I'm like, wow, they finally did it right after
Yeah.
years of speculating. And what was interesting was there was a couple of folks like in the room that I knew from the profession, and they came up to me and they said, "Oh, this is a good year for." life insurance companies because terminal tax obligations are going to be going up, right? And I hate having that be the way that this is done, but that's the reality, right? Is when you increase your capital gains inclusion rate, you're going to increase the amount of capital gains taxes owing on realized capital gains during your life and when you pass away. So, you know, coming back to it, right? Like, I think everybody just needs to reevaluate
Yeah.
and make sure that they have sufficient liquidity available to them, when in the event of passing, because if there isn't that liquidity, now all of a sudden your estate can be faced with a forced liquidation scenario, and
Hmm.
that can create, its own challenges. So the reality is life insurance becomes such a powerful mechanism because it ensures that liquidity is there, and whenever there's liquidity, it can also calm fires down, like to the extent that there's fights within the family and
Yeah.
all this other stuff. There's so many psychological things that can be minimized as well as a result of that, especially during a period of grief, right? So
Yeah.
it's one where, just having those proceeds there to help fund that terminal obligation can go a long way, right? So,
Yeah.
I'd say, like, sometimes life insurance has that negative, stigma associated with it, but the reality is it's such a positive tool, right? And I
Hmm.
I think, Galen, the way you do it, right, like, it's really the right way, right? And I think that, for the folks listening on the line, like, like I've worked with Galen for several years, and I just find that his approach to this is really awesome. And it's one of those things where I think, picking his brain on some of this stuff may be in your best interest, right? So
Yeah, no, I appreciate that. I'm glad you said that. And certainly,
yeah,
yeah, I mean, when we're talking about the impact of these changes, I mean, I always look first and foremost, like, is this impact going to affect something that somebody cares about? Because I do
yeah,
meet people who just don't care. They're like, you know what, I don't have kids, I don't have whatever, like maternal tax, I don't worry, like, try to help me spend all my money while I'm alive. I don't care what I leave behind. But when I look at the clients that I've done plans for in the last couple of years who like, oh, I want to make sure the cottage stays in the family. How can we make sure that we fund this issue with life insurance inside of a corporation? Like those very specific, okay, like where's this money coming from? How are we going to make it easy? How are we going to take out that potential infighting? All those things, like certainly for those clients for whom we've uncovered that need, it can make a ton of sense. And there are people for whom it just doesn't make sense. But yeah, we look for that need, see if it's there. If it's not there, okay. But if it's there, we say, okay, this might be the tool that's going to help solve all these problems.
absolutely, absolutely.
Perfect,
Liquidity
perfect.
is a good thing.
Yeah, yeah, exactly. Awesome. Well, I really appreciate it. That story of you being in that room and hearing that rumbling kind of wave through the room around capital gains. I mean, you nailed it. Like ever since I became an advisor, I'd go to budget updates put on by local CPAs, and every year it's like, is this going to be the year? Is this going to be the year? Like, is this? And I feel like it's been like 13 years. They like people have been speculating, like, are they finally going to do it? And I'm sure that rumbling was pretty loud because it's like, oh, they finally went for it.
And it's funny because this was the year that we weren't expecting it either, right?
Right.
It was one where everyone just gave up on it. You never saw anything from the accounting firms. Oh, do your surplus strip transaction before the capital gains rate increase. Nothing like that. And yeah, anyways, it was funny. Like, even our budget document, was, you thought there would be nothing, right?
Yeah, I remember that. I remember that
Yeah,
like first
yeah,
line. Yeah, yeah,
yeah,
yeah.
yeah.
Awesome. Well, thanks so much for joining me. I really appreciate your time. I appreciate your insight. I mean, really cool having someone who was right there when the news was first hitting the ground. So yeah, I appreciate you taking the time to walk us through the impact, what people might be able to do about it, and yeah, inside of corporations and outside. So I appreciate it.
My pleasure, Galen. Thanks for having me out, and thank you for everyone in terms of listening to this as well. Thank you.
Awesome. Take care.